best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. It's Kerry, Lutz, and back from a very brief hiatus off to the sunny shores of South Carolina for some much-needed R&R. And Danielle Park is with us right now, and one of her forecasts has proved to be eminently correct. That is that the dollar, the U.S. dollar, that is, would strengthen and strengthen and strengthen. And indeed, that has proven true. And Danielle, welcome.
Hey, Kerry. Thanks for having me.
Yeah. So how did you know years ago, 3-4 years ago, that the U.S. dollar was going to be the best looking horse in the glue factory?
Well, it's really nothing brilliant. It's a humble study of cycles. I talk about this all the time, and people think it's some kind of, like a magic potion that one drinks to see the future or something. But really, it's just sort of an assessment of the duration of cycles that we try and do on a constant and continuous basis. So the U.S. dollar index peaked against the basket of world currencies in March of 1985 at 140, Kerry, and it fell 52% all the way down to, I sort of made a triple bottom around the 70 range back in 2006-7, in that period. And then as humans are so wont to do, people just took out a ruler and drew a line straight down from there, except that currencies are typically moving in cycles, and we believe that the decline in the U.S. dollar had a lot to do with the easy money policies and the rate cutting that came out of monetary policies. Greenspan came into his tenure at the Fed in the late 80s, and easy money policies became more prevalent, bailing out the banking sector, all that stuff, spending on 2 wars under Bush Jr., cutting taxes. All these things really were degrading the balance sheet of the U.S. At the same time as rates were coming ever lower. And all of that was why we saw this great depreciation in the U.S. dollars against the world currencies. And then when it was making its double and triple bottom, we were watching it technically. My partner's a technician, and he was saying, if it holds here, then we could very well be into the next cyclical upturn. And indeed, that happened in the crisis in 08. You saw everything sell off except the U.S. dollar being the benefactor of inflows. And again, you go back to valuations. This is why valuations matter. When something has already declined 50 and 60%, right, and you get a crisis in world asset markets, relative value wins the day. So when other things are all insanely valued, as they were in 2007, you had high yield debt and equities of every color all over the world, commodity prices, everything basically, real estate was all extraordinarily overvalued. And one of the rare places of opportunity or that had already come off 52% happened to be the US dollar, which happened to be the world's benchmark currency, the most fluid, liquid market in the world. And so it indeed received inflows, and you saw that rally in the financial crisis. And then what did the Feds start doing? They began another, monetary experiments in the form of repetitive QE tranches, and that was also, a little bit of a weakening again for the U.S. dollar. But keep in mind that even with the rally that we've seen since 2011, really, as the global economy turned down and, the Feds kept trying their QE, what you've seen to date with the index having bottomed near 70 and rallied of late to 86, we're still only 12% back of the 52% decline that took place before that. And so our work suggests that $100 range would be well within the realm of reasonable. If it was to break out of the 100 range, you could see indeed a new cyclical uptrend from there. So I think, it just goes back to keeping an eye on what's happening, not falling asleep in belief of any one trend. It was a very contrarian position to take back in 07 when everyone had written off the dollar and believed that alternatives were going to be, the only way to go. And it's starting to become more consensus, but I still think that with all the turbulence in other markets at the moment, we would look for a continuation of U.S. dollar strength, not in a straight line, and there's going to be some volatility, but it wouldn't surprise me if we continue here for a period of time before we got to a next test, perhaps.
And we're seeing like huge flow of funds into the U.S. from around the world. Some of it's flight capital, and a lot of people, a lot of investors seeking stability, and a lot of investors seeking return that they just can't get anywhere else in the world, right?
Yeah. And you have, again, you look around, we're right back to a similar sort of juncture. If you look at asset opportunities, I mean, let's face it, capital has to flow somewhere. There's a lot of captive capital in the world. It has to be somewhere. Can't be under beds and in drawers. Has to be in some kind of a store of value. And there's only so many ones to pick from that are liquid and broadly traded. And again, I look at what's available today in the world. And yes, the US dollar has, as we said, rallied 12% off the low in 07, but it's still relatively attractive valuations relative to overvalued stocks all over the planet, incredibly highly valued corporate bonds all over the planet, commodity prices which have come off a great deal but are still relatively high. I think, copper is still around $3 here. So gold and silver, of course, silver's been crushed. Gold's come off significantly. But I think the other thing that people missed in their glee for some of these alternatives, look at Bitcoin as another alternative that was put forward.
Yeah.
And the point is that people kind of missed that the reason those things were rallying so much in the preceding period was because the US dollar was falling in value so much. It was really leading those trends. And so when everyone only expected that to continue, they therefore also expected the alternatives rally to continue. And of course, you had an abrupt reversal. So if you look at the lack of substitutes that are out there and the relative valuation play, and the relative growth story in the U.S. being relatively better than most places in the world. I mean, you and I were talking about Germany briefly there before the call. There's the most lauded economy on the planet, the most, disciplined workers, less domestic debt, not a housing bubble per se, although their housing prices have gone up, but nothing like we've seen in many of the other developed countries. And you still have Germany in the slipping into recession as we speak. Because why? Because they need exports. They need people elsewhere to buy their goods. And the U.S. still contains within it a relatively high proportion of the world's wealthiest people and enough population to consume a good deal of their own goods. And as we say, have the benchmark currency and relatively higher interest rates, Kerry. I did a piece quite some time back about the relatively available, Japanese rates at next to nothing, European rates at next to nothing. So where do people go if they want to have a liquid, relatively safe place to park capital and earn something while they're sitting there? North American interest rates are still the highest that you can pretty much get in most of the developed economies. So all that is supportive, I think, of the currency, but not so much of the asset markets, right? Not so much of, as I've already touched on, commodity prices, which I think have further downside, and not so good for S&P earnings, Kerry. Because again, back to relative valuations, the S&P earnings have been, we've paid forward so many years now in the current valuations for expected earnings trends to come. And people have misunderstood that a good deal of the earnings gains that were made in the past few years were because of, a falling US dollar making exports more competitive. Now you have that exact opposite. So multinationals are not able to sell overseas. When they translate their sales back, they're worth less. I think that's negative for stocks overall.
Yeah. Well, Martin Armstrong says, there's really no choice if you've got billions of dollars that you're playing with, that you're in charge of any corporation, wealthy individuals, whatever funds, you're stuck with the dollar, whether you like it or not. At the end of the day, you're not going to be sticking it in a European bank that you don't feel secure about. You're not sticking it in Japanese debt or Chinese debt or a Chinese bank or a Japanese bank. So I think the biggest surprise is that even though the U.S. is doing things that really are long-term damaging to the system, like kicking Russia out of SWIFT and, extending the extraterritoriality of the U.S., going after tax cheats, things that really are going to undermine the primacy of the dollar in the long run, no question about it. For right now, everybody's stuck with the dollar and there is no place else to put your funds. The markets in the U.S., the capital markets, the structure, most highly developed, most liquid. And, where do you go? Like, where in China are you going to stick multi-billion dollars and know that the next morning you're going to have access to that capital?
That's the truth. That's it. Exactly. So, and the other thing is, there's some movements afoot. Now, I dare not get too optimistic, Kerry, but there's some movements afoot that smell like a little more restoration of legal principles in America. Let's talk about the financial sector, for example. You've got Eric Holder on the way out. You've got a new person yet to be defined. You have the SEC and the Attorney General's office floating all these whistleblower bribes or money available to people who want to come forward and turn in banking crimes. And indeed, today in Britain, we see that there's some high-profile banker apparently pled guilty personally this morning in a British court, Kerry. Mm-hmm. They haven't named him yet because there's some big deal going on, which will no doubt bring in a bunch of his co-workers or executives. But there's talk about the Justice Department in the U.S. has a fresh round of legal actions being lined up against world's big bankers. And I'm just thinking that we may actually start to get some of the really necessary legal ramifications put back in place for this aberrant illegal behavior that's been running wild all over the finance system and sort of aided and abetted by the political system. So if we get I know it's not going to be fixed overnight and it's not something you're going to rout out ever completely, but in terms of restoring public trust or international trust, if you can get some of the regulations and the prosecutions to stick, I think you have a better chance of, again, people looking relatively around the world. They say, where is my capital likely to just hold ground for a bit here? And that's really the test. People have been so panicked about how do I make gains that they've, chased after every piece of junk out there and poured capital into it. And, that works for a while until everything mean reverts and they start bleeding. And then they flee out of there and say, now, okay, where do I just be able to put capital that, again, as you say, respects the rule of contract at least, and hopefully, is in a currency that's at least holding its value or going up. And I think everyone's becoming more focused on preservation of capital at this point rather than return on capital. And again, that all favors the U.S. system relative to others as well.
Yeah, well, it will be interesting to see.
FSN Radio. It's all about what's next.
This show is brought to you by Audible, your leading source for audiobooks and courses. You know that I'm a huge Audible fan. I've got over 300 audiobooks in my library and have been a member for over 6 years. They've got a great deal for you. Join now and get a 30-day free membership and a free book. Go to audiblepodcast.com/FSN. That's audiblepodcast.com/FSN. I just downloaded Lee Child's latest in his Jack Reacher series. I can't wait till my drive to South Carolina to start listening to it. I know you'll love Audible as much as I do. Go to audiblepodcast.com/FSN and get started today.
The Financial Survival Network. It's all about what's next.
I think that in the Department of Justice, there was a quiet rebellion taking place where U.S. attorneys are actually starting to prosecute corrupt Democrat politicians. Saw this in California, saw it in a number of states where they just started going after them, whereas for the past 5.5 years, under the Holder regime, it had been basically hands off. So, we will see who is put into place. My guess is it's going to be somebody non-controversial or relatively non-controversial. I don't believe that the president wants a major eruption to take place in the lame duck session of Congress that's going to happen after the election and before the end of the year, assuming that the Republicans manage to take control of the Senate in the elections. If that happens, honestly, I'm not sure if it's going to matter. But a return to the rule of law would certainly be healthy. And hey, we didn't even talk about the I can't remember her name, the attorney.
Carmen?
Carmen Segarra.
Her tapes.
Who was hired by the Fed to be a more aggressive, assertive regulator. She tries to go about and do that in her stay at Goldman Sachs. She does what she thinks she is hired to do, and then she's promptly terminated, but not before she gets about 46 or 48 hours of recordings, and they're played back. There's nothing in there saying, not what you would call a smoking gun of, hey, let's just rip off the country and steal everything. But you kind of get the feel of regulatory capture that's taken place.
Completely. And Elizabeth Warren was talking about that this week. And, we got Andrew Huszar, who was at the Fed, who wrote that. Remember, he wrote the piece a couple of years ago saying that, he's sorry, America, for QE and all that. I think, it's none of these people in themselves are enough to turn the tide, but history shows that it's an incremental impact, right? It's like a drip, 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 until finally what happens, I think, is that the politicians become so concerned about their reelection and so embarrassed about who they've been holding hands with, that they start letting go of those hands and trying to distance themselves. And I think that it's not, I'm not saying it's a long-term indefinite phase they go through this breakup period, but I think that there's been enough scandal, and it's global, and it's, and there's enough democratic uproar all over the world that look at the Hong Kong riots, young people taking to the streets saying, we're not prepared to just endorse the status quo and the thievery that's been going on. So I think, incrementally, all these things give me hope, because as you and I have talked many times, we're just waiting for, a Pecora-like moment where something galvanizes the public's attention enough that they finally put in four basic changes, which, I outlined on my blog this week. It's just cut that line of credit between the taxpayers and the risk takers so that you don't have governments backing up banks. That's the first thing. Pay banker bonuses in bonds instead of in equity so that they don't have an incentive to blow the companies from here to Guatemala, and hold the executives personally accountable for their malfeasance. Stop letting them hide behind the corporations. You can't have a corporation doing an illegal act without a directing mind. Let's cut the nonsense. And then clawing back executive pay. That's the other thing. Just claw back the executive pay. Jamie Dimon should not get a mammoth bonus for negotiating a whole bunch of billions of dollars of settlements with, regulators for the illegal acts of their bank. They should give up their executive pay. If you could just restore even the first of those things, it would sort this out. Because cutting the line with the taxpayer would be, if you had to do one thing, that would be enough. Because at that point, the risk takers would be failing on their own and not being able to, steal from the public purse every time they make a mistake. And that would sober them up really fast. Back to the partnership model, right? Where the Goldman Sachses of the world were all about their own risk management. That's what we need. And until that happens, everything else is going to be a waste of breath and time and energy, and it's all window dressing, and it's not going to be the change that is required.
Well, I'm not too anxious to see the government dictating how much people are paid. What I would like to see is a model of corporate governance where there really is shareholder governance, and where becoming a CEO of a company doesn't become a license to steal and to take everything you can, and where the business judgment rule is where whatever in my business judgment I determine is good for the company goes, and where somehow these companies are actually held to a higher standard, not where it just is out of hand. And
I'm not even saying they have to say how much they can be paid. I'm saying have a rule about how much compensation can be in the form of equity. Just limit the amount that can be in the form of equity. I don't care if they want to pay them $40 billion a year of their own corporate bonds, but their whole obsession would become about controlling risk and making sure that those bonds can be repaid, not in levering up the risk to suicidal portions. And I think that's the distinction that needs to be made.
Yeah, well, Warren Buffett in his companies does not give out stock options to anyone. It's all about performance and real performance. And I was at a conference, and this guy, Joel Stern, has a method of compensating managers where you basically do it on profits compared in your industry and risk. And, if you do better, then you get compensated better. And let's stop with the stock buybacks, which are just a way to inflate per share profits without really doing anything for the benefit of the company. It doesn't really help the company. Just because you have less shares outstanding, your per share earnings go up, assuming that everything else stays the same, but the company's not really doing any better, is it?
No, and they've been spending more than 90% of net income the past many years to buy back their own shares, which is a short-sighted strategy, because now we get into the hard part of the cycle where sales are going to continue to fall for a while and exports will be weak, and you're going to have no or less buffer built into the companies. Now all that good cash you took and spent on shares that are plunging will be shown to have been a bad investment, right? It's not something, it's not strategic. It's a short-term fix for the share price, but it's not focused on how to build a more robust balance sheet or company or business model going forward. So it's been a very reckless period. The financial crisis, as we've said before, brought everything to light, but then didn't force any actual change. They just papered it over. I think that paper is coming back off again now. And this next cyclical downturn, I have some hope, will be more revealing, because it'll be harder to clean up again this time. With that much more debt in the world, and it's so recent in the conversation, and with the regular economy having recovered so little, and with wage growth having been so anemic, there's not much tolerance for disappointment. And as I say, with share prices now back at these bubble levels, with no buffer for disappointment, I think that all makes the system pretty vulnerable again. So that encourages me, because it's time to get on with admitting some facts and seeing some truth and valuing things so that they have an actual investment thesis, not just a speculative thesis, and we'll get some proper allocation of capital again in the world.
Yeah, and that would be a nice thing to see, and to see risk, like you say, actually get measured by the rate of interest charged, because a subprime borrower who is going out to buy a new car should be paying a higher rate of interest than a prime borrower. And that's not the case now. And a subprime borrower who's buying a new home should be able to get credit based upon the risk involved.
Here's another thing I noticed this week. So there was that story about Bernanke not being able to refinance his home. Did you catch that?
I did see it.
But here's the discussion that I didn't hear a soul have, Kerry. Why in the name of heaven is he 58, 56, something like that? Why does he have a big mortgage on his house is the first question. Americans have been lulled into this idea that if you can borrow to buy a house, it's a good idea. It's not a good idea when you're nearly 60 years old. You should have your house paid for. And this whole obsession with inflating asset prices by giving people deductions on things like mortgages to put more capital into housing than should be is how we got into this mess in the first place. We really do need a sea change in thinking that stops believing that if you can borrow money, you're wealthy.
Yeah, well,
pay off your stuff.
That's going to take a sea change, all right. So you'll find Danielle at jugglingdynamite.com. Link is found at financialsurvivalnetwork.com in the show notes to this interview. Don't forget to sign up for our newsletters. Danielle, we'll talk to you in a couple of weeks.
Okay, Kerry, thanks.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.